Welcome back to the deep dive. Today we're digging into a really fascinating business narrative. It's like Shakespeare's Prince Hal.
Oh, right, the wild young prince.
Exactly. Starts out dissolute, high risk, but then transforms into the great King Henry V.
A powerful leader, stable.
Right. And that journey, it perfectly mirrors what we see with certain stocks. You've got the chaotic rule breaker, that's Prince Hal.
And then the steady, dominant rule maker, that's King Henry V.
And this whole idea comes from the Motley Fool Rule Breakers, Rule Makers. It's a book from back around 1999.
Yeah, and it's definitely aimed at more experienced investors, people like you listening who get risk but are looking for those really dynamic growth stocks.
So our mission today is basically to unpack what makes these two types of companies tick, what separates them.
Okay, let's start with the rule breaker, the Prince Hal, if you will.
High risk, high potential reward. The book says their number one trait is being the top dog and first mover in an important emerging industry.
Yeah, not just disrupting, but creating a market.
Like Whole Foods, maybe?
Exactly. Think about them starting in Austin, 1980. Just one store.
And the whole idea of a natural food supermarket was pretty out there then, wasn't it? Organic wasn't mainstream.
Not at all. They were basically inventing that category. They weren't just competing, they were defining the space.
And being first gives you incredible power, that first mover advantage. Amazon's a classic case, right?
Oh, absolutely. They launched online book selling in 95.
And Barnes & Noble, they didn't really jump in online until, what, 97?
Right. So Amazon had this crucial 2-year head start, built a huge customer base, got that momentum.
Which let them expand into CDs, other stuff, way more easily.
Definitely. But there's a really important warning here. The book calls it the faker breaker.
The imposter. Looks like a rule breaker, but isn't.
Precisely. Not every company that grows fast is built on solid ground. You need real momentum, not just financial tricks.
Boston Chicken comes to mind. Boast.
The perfect example. They had this huge IPO in 93. Everyone was excited. Their profit margins in the mid-90s looked amazing, like over 21%.
What's good on the surface?
Totally. But the actual business model, it was deeply flawed. Their expansion was basically funded by loaning money to their own franchisees, these area developers.
Okay, wait. So they were lending money out.
And booking fees tied to those loans as immediate earnings. The growth wasn't coming from selling chicken profitably in the stores day to day.
It was based on these one-time financial transactions from headquarters.
Yes. It wasn't sustainable profit from the core business. That's why it collapsed. A real rule breaker needs, 2 or 3 years of genuine advantage from its business, not just leverage.
Okay, so that difference, real momentum versus just financial gains, that brings us to the rule maker, the King Henry V.
Right. If the breaker is a rocket, the maker is more like a freight train. Steady, dominant, maybe less spectacular day to day, but unstoppable over time.
And their power comes from
Mass market, automatic repeat purchases, usually inexpensive stuff, convenience items.
things people just buy over and over without thinking. Habit.
Exactly, like Gillette razors or maybe Fig Newtons, definitely Coca-Cola. You just buy them again and again.
And that repeat business over decades, that's where the real power is, isn't it? The Coke example is pretty staggering.
It really is. The book mentions a $4,000 investment in Coke's IPO back in 1919.
Okay.
If you just reinvested the dividends, by the late 90s, that was worth over $650 million after taxes.
Wow. $650 million from 4,000.
That's the power of the rule maker. Long-term compounding built on simple habit. That's how they become kings.
Okay, so we've seen the high-flying breaker, the deceptive faker, and the enduring maker. What's the big takeaway for you, the listener, from all this?
I think the crucial thing, the lens you need to apply, is looking at percentages, not just raw points or numbers.
Right, that $650 million for Coke sounds amazing, but it's the percentage growth over time that tells the real story.
Exactly. Or think about market volatility. The news shouts, Dow drops 500 points, or best one-day gain up 380 points.
Sounds huge. Makes headlines.
But those raw points are misleading without context. What percentage of the total market value is that drop or gain? How does it compare historically?
A 380-point gain today might be a much smaller percentage move than a 50-point gain was decades ago.
Precisely. And the faker breaker, Boston Chicken. They looked good on points, big IPO price, high revenue numbers, but their percentage growth in sustainable profit, 0. negative even.
So the challenge for you is to develop that critical eye. Don't get swayed just by the big headline numbers, the points on the Dow, or the initial splashy IPO price.
Look deeper, understand the relative performance, the percentage change, the context. That's what reveals the true momentum or the lack of it.
Whether you're looking at stocks or, frankly, almost anything else, it's about the percentages, not just the points. That's where the real insight lies.